Hey guys, Daniel here with Value Investing with Daniel. Thank you for tuning into this video. In this video, we're going to be trying to calculate a fair value price for Costco. We're going to be using the earnings power value method, so let's get started. To start, we're going to have to figure out what the sustainable current free cash flows of Costco is, and in order to do so, I'm using Y charts here. We can see that the average free cash flows over the last 5 years is about $4.4 billion. So this means that on average per year over the last 5 years, Costco's made $4.4 billion per year. So let's write that here on paint. So on average, their cash flow is 4.4 billion on average. Okay, so this is the average cash flows over the last 5 years per year. The next thing that we're going to have to do is calculate the earnings power value of the company. In order to do this, we take this number, 4.4, and we divide it by our cost of capital. Now, the cost of capital for equities currently is going to be somewhere between 7 and 13%. So if a company is a very safe company with low debt in a safe, simple industry, we would probably be confident in using a cost of capital of somewhere like 7 or 8%. In a high-risk industry, in a company that has a lot of debt, something that's fast-changing, for example, we might feel that we need a 12 or 13% cost of capital. The lower the cost of capital, the more the company's worth. The higher the cost of capital, the less the company's worth. So I'll show you what I mean using the calculator here. Let's say, for example, in this case, we're saying it's 4.4 billion, the sustainable free cash flows. If we're saying there's a 9% cost of capital, then the company would be worth 49 billion. But if we say there's a 12% cost of capital, then the company would be only worth 37 billion. So the higher the cost of capital, the less the company's worth. The lower the cost of capital, the more the company's worth. In Costco's case, we have to look at it from the perspective of this being a company in a relatively stable industry with a competitive advantage. So we're likely to use a cost of capital somewhere between 7 and 9%, depending on your level of comfort. I always like to be conservative in my estimates. I think that 7% is a little bit too low. For a great company like Costco, I think perhaps something like an 8% cost of capital could be appropriate. Ultimately, it's up to you to determine what cost of capital you're comfortable with. So if we do 4.4 divided by 8%, that will then give us the earnings power value of the company of being 55 billion. So we're saying here that the earnings power value of Costco is 55 billion. This is the non-growth the non-adjusted, 55 billion, not 55%. This is the earnings power value that we would utilize for companies without a competitive advantage. But when a company has a competitive advantage, we have to use the enhanced earnings power value, and I'll show you how we do that here. The way that we do this is we take the return on capital of the company, we multiply that by what could be called the retention ratio, and divide this by the cost of capital, which we said was 8%. We take this number, and this will give us our value creation factor. Okay, so the return on capital times the retention ratio divided by the cost of capital will give us the value creation factor. We multiply the earnings power value by the value creation factor, and that will give us the enhanced earnings power value. Okay, so let's do this together. So the return on capital on Costco we'll have to figure out. If we look at, for example, the return on capital employed, we can see that over the last 5 years, it's about 24% per year. Let's just say 23. So we can say here that the return on capital is 23%. Now we have to figure out what the retention ratio is. What I like to do to figure out the retention ratio is I like to see what the sustainable free cash flows are. In this case, we said it was 4.4 billion, and subtract the total dividends paid. So Costco makes on average $4.4 billion a year. They pay out $2.3 billion in dividends, so meaning they reinvest $2.1 billion back into the business year after year. We take 2.1 and we divide it by the 4.4 total that they make, and we see that they reinvest about 48% of the money that they make. So 23% is the return on capital. They reinvest 48% back into the business. Okay, and I'll show you how we did that again. So if we look here, the free cash flows, the average sustainable free cash flows of Costco is $4.4 billion, and they pay out, in terms of dividends, they pay out $2.3 billion. So what you don't pay out in dividends, you reinvest back into the business typically. So that means they reinvest $2.1 billion back into the business. If we say they're reinvesting $2.1 billion out of $4.4 billion, then that means they're reinvesting 48%. Okay. And going back to the cost of capital, if you search, for example, Costco weighted average cost of capital, will show you what the academic way of calculating it is. You know, people will say, as you can see here, 7.7, 8.5, whatever, 9.3. It's all going to depend on what numbers you're comfortable with at the end of the day. So anyways, we say here that Costco reinvests 48% out of the 23, and we're dividing all this by our cost of capital. And remember, this is going to then equal our value creation factor. What was our cost of capital? We said that our cost of capital that we're going to use, because we feel comfortable with it, is an 8% number. So we're going to put 8% here. 8% cost of capital. So let's solve this equation together. 23 times 48% gives us 11.04, divided by 8 gives us a value creation factor of 1.4, equals our value creation factor. So let's go through that one more time, just that way everybody's confident. 23% is the return on capital. They reinvest 48% of that back into the business, so that's 11.04. We divide that by the cost of capital, and that gives us a value creation factor of 1.4. Now, what do we do with this value creation factor? We multiply it by the earnings power value that we calculated at the start. We take 55 and we multiply it by 1.4. Remember, 55 was our earnings power value. Our earnings power value is calculated by taking the average sustainable free cash flows and dividing it by the cost of capital. Sustainable free cash flows for Costco is $4.4 billion divided by an 8% cost of capital gives us an earnings power value of $55 billion. We take the $55 billion earnings power value and we multiply it by the value creation factor that we just calculated. That gives us a fair value of Costco of $77 billion. Okay, so what we're saying here is that a fair value price for Costco would be probably around $77 billion. Now this is going to vary a little bit by the numbers that you choose to input into this equation, but $77 billion is going to be the approximate fair value of Costco. If we look at Costco's current enterprise value, we can see that it's currently trading at about $208 billion. So $208 billion, this means that, you know, roughly speaking, Costco is overvalued by quite a substantial margin. $208 billion, you know, compared to our fair value calculation of $77 billion for Costco. So I hope this video was informative. I hope that you can now understand how to calculate both the earnings power value and the enhanced earnings power value using the value creation factor. This is a very simple strategy. Now you can see really why the greats, like someone like Warren Buffett, well, not just the greats, why you can calculate the fair value of a company in your head. Think about it for 1 second. If you already know what the sustainable free cash flows of the business are, let's just use an example. Let's say a business makes, let's just use simple numbers, $10 billion a year in free cash flows, right? And the cost of capital is 10%. Then the earnings power value of the company is going to be $100 billion, right? Now, you take the $100 billion and you figure, does it have a competitive advantage? If it does, what is the competitive advantage? Once you figure that out and you figure out what the return on capital is, let's say it has a 30% return on capital and reinvests 100% of the money back into the business, then you would say 30% times the 100% retention ratio is 30% divided by the cost of capital of 10% is a value creation factor of 3. We take the 100 billion earnings power value and multiply it by 3. That gives us an enhanced earnings power value of 300 billion. So all this can be done basically in your head. Once you know how to divide by certain percentages, you know, you're able to basically do all these calculations because it's just an approximation anyway. So as long as you're roughly in the right ballpark, you'll be able to do all this mathematics in your head very simply, very easily. As you can see, there's nothing complicated, just multiplication and division basically. So I hope the video was informative. Please like, and if you have any questions, you can always ask in the comment section down below. If you're watching my videos and you haven't subscribed, be sure to subscribe because I'll be putting out more content soon. Thanks. Hopefully I'll be putting out more content soon. Thank you.